Hello traders, Gary Wagner here just before 11 o'clock in Honolulu, 5 o'clock in New York on Thursday, the 4th day of September 2014, and this is the daily report for gold and silver. We have a continuation of the downside pressure we have seen in the precious metals markets. We have an incredibly strong dollar, almost trading up a full point on the day, to gold currently trading at $1260.69, puts it off roughly $8 to $9 on the day. The low $1259.80, the high $1278.20. Silver also drifting lower. It is actually off almost 0.75%, down about 14 cents on the day. Just precariously above $19 per ounce, but I'm not convinced that is going to hold. Current print 1901, 1902, the low 1893, the high 1945. We'll talk about silver in just a little bit. Traders, following news of quantitative easing over in the European Union, a devaluation of the euro dollar, it's all about the dollar. 83.82, up about a point on the day. Tremendous spike in the market. This is a daily chart. You can see the activity. This is that one-day move in the market. Equities, which had been trading higher throughout the day, are currently trading lower. We'll see what happens as the market comes close to a close. Last time we really looked at the dollar, we talked about the fact that the last time we saw the dollar hit this level, and this of course was last week, we saw a small retracement. That's this red candle here. And that matched up to what we saw the market do in September of last year, the September of this year. And then following that top, we had a tremendous spike to the downside, actually trading down to about 79. Now, this time around, we're looking at a completely different scenario because we saw a little bit of weakness come into the market last week, a potential top in the market, but as you can clearly see, we've had a defined and utter breakout to the upside. So what has that done for gold? Well, without a question, without a doubt, it's put some extreme pressure on gold. Now, we were looking at whether or not we would hold, in terms of this compression triangle right here, whether we would hold this support line. Of course, we had a series of lower highs, a series of higher lows. We believe that the market, once it hits the apex, is going to release some energy, and it does appear as it got close to the apex here, it did break and it broke below it. My sense right now is this is a critical level. We broke below it just a little bit, but any kind of break below 61 absolutely signals that we will be short players in this market. I would look for the potential of lower pricing in gold if it cannot hold 1261.16, and that of course is our 61% retracement. Now, when we consider what happened last year about the same time, and I'll draw your attention to this of course is September of last year. We are now in September of this year. Now, big difference, because through June, August, up until September, we hit this high coming in right at around, I believe it was about 1420 to 1435. It looks like, because this is 1450, maybe 1410, just above 1400. And from there, we saw the market really for a period of 3 months. In other words, September, October, November, going into December, just trailing lower pretty much across the board. You had one little rally come into the market. Then from there, about mid-December, we have the market hitting the second of this double bottom. This is 1180 right in here, and it was the second time that the market had really genuinely traded to that point. And from there, we had a dynamic $200 rally. That rally, of course, was to be short-lived because we then retraced, and we retraced even below a 61% retracement to 1261, but we did see a recovery. As the recovery came in, what we started to notice really more than anything else was this compression coming in, because we had these series of highs that were going lower. We had a series of lows, though, that were moving higher. Typically, when a market is simply moving down, you'll get lower lows and lower highs. That wasn't to be the case because we had this market coming into this compression. The market right now, as far as I'm concerned, it is an absolute crossroads, a precarious position, and a break below 1260 to me signals a couple things. First of all, let's go ahead and clear this chart up. If in fact we see that our first real target for the market has got to be around 1240, and that is based upon this previous low. You've got a 76% retracement just below that at 1230, and then you don't really have any kind of strong technical support in this area really until it hits the bottom or 1180. So what we have to ask ourselves is, are we going to see a repeat of last year in which we saw the market peak out in September and trail lower for the rest of the year? In this case, when we look at this high right here, that happened roughly at the beginning of July. So the market from, call it May, when it hits this bottom at, this would be 1240, you had a $100 rally. The market has really not been able to look up from there. So for that reason, traders, I have to say that this dynamic break that we witnessed the other day could be a game changer in terms of the way the models that we're looking at, as well as the technical indicators. When we look at the fundamentals in the market, we've got geopolitical hotspots, and those could really heat up at any moment. That should have a bullish effect on gold if in fact any of these events really begins to escalate. But at the same time, the dollar is what you've got to look at, and with such strength, the dollar's really been rallying since the beginning of July, when it was trading at around 80. It's up at around 83. You've got almost a full point today. So you've got a market that has moved literally from 83 to almost 84 in one day. That's a tremendous spike within the market, and we're seeing a net result, which is weakness in gold and silver. So traders, have gone ahead and pulled up. This is a 2-day chart. We've used a couple of different Andrews pitchforks. We looked at one Andrews pitchfork, which has been the predominant trend in the market over the last couple of years as the market really meandered lower. It stayed within these channel lines. This is of course, our 0 prong right here and our 100% prong right here. I added this, which is a negative 23, and I also added a Andrews pitchfork that would plot a positive move up. As you can see here, this particular bottom of the handle was actually off of this low, but I'm using a shift pitchfork. There's the shift, the modified, and the standard to give you a kind of an idea. On the standard, and this is the standard, of course, you can see that it does come in off the bottom. But if we were looking at any kind of a real market move, there was no way we were following our standard pitchfork. We didn't have anywhere near that kind of a strong rally, so I used a shift, and a shift really modifies it, as you can see. And again, this is really what I'm looking at, because I really want to see a combination of factors before we initiate a short position. And if we get the break as we looked at on that other chart, and at the same time we see a break below this, and this is a very gradual incline to the upside, but very gradual. In other words, you're not looking at more than a 15 to 20% degree angle. If we consider straight line, something like that, between these two lines, it's a very nominal angle to the upside. And if you can't even follow that, obviously we could be looking at lower pricing. And so we will act accordingly as more information comes in. But some of the final pegs that we hope not to see on the bullish side, we are absolutely seeing, and we have to adjust our models to react to the current market scenarios. And then lastly, silver, just above $19 per ounce. And the key with me on silver, and what I am concerned with, is on a technical basis, except for possibly this low right in here, which comes in at about 1880, we don't really have any kind of genuine support in the market, whether it be using our Fibonacci retracement or trend analysis. We're going to have to look at historical tops and bottoms. We have one at 1880, and then we have this one at about 1865. I absolutely think that the market will probably track to at least 1880 if we see any kind of continuation. 1865 is where I would look to see if the market finds any support. There's no doubt, strong dollar, weak precious metals. Equities markets are moving to new highs, although they're off those highs, but they have been strong, and economic reports here are pretty solid. Now, they're not so solid in Europe, but realize when you take a look at the S&P 500 and the industries that compose that, approximately 70% of their income is derived from the United States, with only about 11% of their income being derived from the European countries or the European Union. So it's not a tremendous amount in terms of percentage, and for that reason, if the EU has some tremendous struggles, I don't believe we're going to see the U.S. market simply fall apart. They will be affected, but 11% is not a majority by any stretch of the imagination. This has been Gary Wagner, wishing you as always good trading. We will talk to you tomorrow on Friday for the weekly wrap-up. Bye-bye.